Hello, everyone, and a very warm welcome to today's major markets update for Friday, September the 13th, 2024. I hope you had some good luck in the markets today because it's, of course, Friday the 13th. Woo. Anyway, today we're going to review the NASDAQ 100. I didn't provide an update yesterday because the email format doesn't lend itself very well in conveying the message that I want to say on where we view the NASDAQ 100 currently. It all depends pretty much on one, what was the wave 1-2 count all the way back in 2022? What's the wave 1 and what is the wave 2? If you miss that one, you will, of course, miss the final third and fourth wave as well. Excuse me, fourth and fifth wave, of course. And also, was the decline in the August fifth low 5 waves lower or 3 waves lower? Can be counted both ways. And yes, that is the unfortunate nature of the Elliott wave sometimes, that it is a matter of interpretation. But the good Elliott waivers will figure it out, and they will provide the price levels above or below which these wave counts will get invalidated. That's the whole crux of the matter. There's nothing else to it but price. And that's why the Elliott wave remains superior, because Elliott wave analyzes price based on a set number of price patterns, and everything else is either fundamental or opinion. So we're going to go straight through these slides. Remember, we can never get it perfect. That's okay. We're only human. And this is, of course, a complex system that we are assessing. And complex systems by themselves cannot be predicted. We can forecast them a little bit ways out, but because they're complex, we cannot predict them all the time correctly. Always make sure to have a set of trading rules. You can use Jesse Livermore's here or your own, but always make sure you cut your losses, never average down losses, and always let your winners run. So then, of course, the importance of stop losses, they save your hard-earned money. Never sit through too big a losses that you can't handle, and never put more money in any position than you are willing to lose. That is really all of it. If you have $10,000, don't put all of it in one position. If you have 100,000, don't put all of it in one position. If you have 1 million, don't put all of it in one position. It doesn't matter how much money you have. Never ever put all of it in one position. And if you have hit your I can't stomach it anymore level, please get out. And that's why we provide our warning levels for the bulls and the bears. So we have, of course, our wave labeling and all the other ways that you can make money. Please remember our ETF trading alert. We just tweeted it today. We're up 20% for the short term, and that is a very good feature. Some might complain, oh, you're not beating the market. Well, are you beating the market? Good for you if you do, but it might probably take a lot of work, and this is pretty much brainless, no thinking, just follow the signals trading, and it doesn't get much better than that. There's no Elliott wave involved here. It is based on trend change, momentum, and strength of the trend. Okay, so if we get a buy signal in a just returning uptrend, most of the time you'll not buy a full position, but a small position, kind of dip your toes in the water. And as long as the trend keeps on strengthening with the usual dips in between, we can add more if we get new buy signals after being stopped out or sold into strength. And again, it is a fantastic way for everybody to learn trading, because the first thing it does is says, for example, buy, set the stop loss here. That's rule number 1. 2, it is then sell partial positions, raise your stop. Sell partial position, raise your stop again to entry. Sell a partial position, raise stop above entry, winning trade, let it run, and we'll let the price guide us, and eventually get stopped out. Of course, no trade lasts forever. It is so easy. A 6-year-old can do it. And again, it is not about beating the market. Bull markets are very hard to beat. What this is about, just as a secret service with Apple, Amazon, is to get good entries, good exits, proper trading. That's what matters. Proper trading techniques. There will be losing trades. It's fine. That's okay, but the track record is amazing. And I'm really, really hammering it home because I know a lot of people want to dabble in options and all that stuff. We just do ETFs and it's good enough for most people. And again, we don't care about beating the markets. Bull markets are very hard to beat. We care about making consistent money without having to think. And that is amazing. That is just amazing. And if you have anything better to say, please let me know. But trading without thinking, just following a signal, is really nice and fun to do. All right. You just don't have to do any homework, etc. Anyways, remember that big losses always require big gains to go back to break even. Last but not least, here is then our NASDAQ 100 wave count. Again, the problem here is, was this the 1-2 setup? Since we had an almost 90% retrace in December of the rally that started in October, it is questionable. Or was this the 1-2 setup? If this is the 1-2 setup, then of course this is a 3, a 4, and not a 5. This is the first problem we're dealing with currently. So I have a hard time. I know for sure the S&P 500 has, of course, a different wave count. That is for sure. I'm much certain about the S&P 500 having put in a wave 3 top and potentially also a wave 4 low on the August 4th low. We'll go over that in a moment, where the dreaded ending diagonal becomes more and more likely, especially with this relentless rally since Monday. Wonderful rally. Wonderful. So this is then the second question we have. Do we count the decline in July into the August as 5 waves lower? It can be counted that way with a subdividing wave 3. 1, 2, 3, 4, 5, 6, 7, 8, 9 waves lower. It is possible, okay? Because here we have a lower low. Then the wave 3 subdivided into a 1 and a 2, a 3 and a 4. And of course a 5. Then this was the spike wave 4, and then these 2-3 days lower were wave 5. It can be counted that way, and that means that the rally since the October 5th low is a counter trend rally. Now, the counter trend rally could have topped already then here a little bit later in August, because we haven't moved above it. We did move above the first warning level for the bears. We did move above the second warning level. We are back above the Ichimoku cloud, the 10, the 20, and the 50-day moving average, as well as remained above the 200-day moving average on the closing basis on all occasions. So this is soon a 100% bullish chart. We have to wait for the 10-day to move above the 20, and those should also move above the 50. That is then a 100% bullish chart, and a trend like you saw here in the beginning of the year, or a trend you saw here in the spring, early summer of this year. This is a 100% bullish trend. Here it is still reversing. So we're right now here still reversing. Now this counter trend rally, if this is indeed 5 waves lower, because it can be counted as 3 waves as well, as you see here, the A, the B, and the C, then this is a counter trend rally, and we could close this gap here at about 20,200. Okay, it wouldn't surprise me that this is then a C wave higher, and we have a little bit higher to go. Okay, it becomes more and more likely on a break above 19,650. That's the third warning level for the bears. Okay, if you're so inclined to remain short, all that stuff. This is for bearish inclined people, and also telling us that if we subsequently move above these levels, the chances that we are indeed going to move higher increase tremendously, right? Above this blue candle was already the first warning for the etc. Okay, so that's why we have those levels. So this is then the first interpretation of the wave count. It counts well, and it matches, of course, with the 1, 2, 1, 2, 3, 4, 3, 4, 5 setup, A, B, and then that. Now the B wave once again can become protracted. Once it starts, we don't know how it's going to resolve itself. B waves are always 3 waves. Can be a zigzag. This is often, most of the time, the first thing you go for. Can be a triangle, can be a flat. Who knows? So this C wave can even retest the all-time highs at 20,700. But let's go for 20,200 first for this blue wave C, A, B, C. Okay, that's very possible. Now, if we then going to look higher, we'll of course have warning levels for the bulls as well. The first warning level for the bulls is a break below pretty much yesterday's close, which is about Wednesday's open, and the market's pretty much opened equal. I must say these are very strong candles, and all the market breadth signals have turned from pretty much a sell to a buy signal. So we favor further upside. And again, is this now then a B, C, where the red wave B was a irregular expanded flat? You see the A, the B, the C. So instead of this being a 3, a 4, and a 5, it is all of a B wave. And you can see here the CSA was exceeded by a marginal amount, making it quite nice, so to say. And then the rally can be counted as 5 waves up. So this is A1, B2. And we're now in C3, 4, and 5 of a potential ending diagonal wave 5 in black. I don't have the upside targets for wave 5 or 5, but they're in the 22 to 25,000 level. Okay. So if as long as we remain above last week's low, this can transpire as we've shown here. Now, this doesn't have to be a relentless rally. If this is a ending diagonal, as I will show you for the S&P 500, it's going to be ABCs higher than we're currently in the A wave. We'll get a B wave, another C wave, ABC lower for 4, ABC higher for 5. I don't have it yet on the map because I'm not too certain about it just yet. I want to show this potential with the warning levels, and that the chart has gone from bearish setup now to a bullish setup. Market breadth has gone from bearish to bullish as well. So that should raise your eyebrows if you're a bear and go like, oh, okay, no guarantees. That's something else. So those are the two conflicting issues I'm dealing with. I wish it was better. I cannot pick one or the other than that the market breadth and sentiment readings suggest further upside. But again, further upside still okay, 20,200. From current levels, that's another 700 points. This is nothing to sniff at. And same here, we can go thousands of points higher, but both of them are short-term pointing higher. Again, I don't give a rat's ass about what the Federal Reserve is going to do with its interest rates. Everybody says when the Fed starts to raising its interest rates, we're going to go into recession. Well, we might all be trained the wrong way, and that's not going to happen. We might go into a recession, but the market's not going to crash. So then we go to the Dow Jones, and this chart was already shared with you a week ago that we saw the potential for this wave C because we felt that the green wave 5 was a little short. All right, the wave 3 topped where it had to, the wave 4 bottomed where it had to, and then the wave 5 should extend better into this ideal target zone between 42,743 and 44,139, give and take, right? The round numbers is about 42,740 and 44,140. That would be fantastic with, of course, an ideal picture perfect number of 43,515. So most likely this gray C wave is now underway. We could see more negative divergence developing. That we don't know yet. And again, we have the warning levels for the bulls on the chart, and we stalled pretty much just at the gray warning level this week. That's it. We didn't break above it. So that's a bullish reversal back above the first warning level. And we keep them as is, okay? Nothing has changed. So then we're going to go to, as I said, 42,700 plus. As long as we hold pretty much above this week's low, and with the first warning for the bulls already below 41,000. On the daily chart, we shared this with you throughout the week as well. This is then how it looks like. We've got the ABC lower, as you can see here, and we're now in this green wave C. Price has moved above almost all levels that the bears would want to hold, right? Except the last one here at 41,600. That's the last one to go, but price is right here at the upper Bollinger Band. It is in a bullish stance with price above the 50, the 200-day, and the 10-day. The 10-day is slightly below the 20-day, but if that one turns around as well, that's the pink or purple line, and then we are in a bullish uptrend, but this looks very strong. So the warning levels are one below today's low or open. It's about 41,150. The second one is at around 40,800. As you can see, those price levels match previous lows and highs and closes. Then the third one is right at about 40,550. It's a little bit above this week's low, but that's based on, you see the price here, and price here, price here. So that's a very matchy level with Wednesday's low. That is then green wave B, and then green wave C should then indeed reach anywhere between 43,060 and 43,778. Okay, so that matches all very well and much better here with these two black wave 5 or red wave 5 target zones. Okay, so this is our preferred wave count. And with that, we expect then also to see the NASDAQ climb higher and potentially fulfill its ending diagonal fifth wave as well, which then will mean that the December low was not a wave two, but the end of the bear market of 2022, contrary to the Dow Jones and the S&P 500. And then we have an alignment. Okay, so no surprise really here. In that sense, nothing a surprise. It's just a matter of which one is it. Then we go to the semiconductors. And as you can see, I'm going through them in alphabetical order. And we've reached the B/2 target zone, which was already earlier this week that we would not be surprised to see this level being reached. And we are there. And again, this chart, of course, looks less bullish as the Dow Jones or even the NASDAQ 100. Why? Because we're still miles away from the all-time high. So I'm not too bullish about this one. For the longer term, I still think that this is a corrective rally. Now, the question is, are we going to see a more protracted red B/2, or is this just part of already the red C/3 wave? I don't know yet. The warning levels for the bears have been broken only on the blue and the gray level. We need to break above 51.75 to really question this blue wave B2, but it's still possible even if we get a fake out. So this chart is still so-so. And then the alternative is then this wave, right? You kind of top here and then we go down, right? That's the idea of this one, just in A, B, and then C. Okay, just wanted to point it out, something like that. Right, that's the whole idea. So the warning levels for the bulls are yesterday's low, and then of course 4,700 below 4,500 really increases the odds that this crash wave down is underway. With of course the final warning for the bulls below 4,300, but I think below 4,700 one should already really take precautionary action for if one has long positions. So that's where we are on the semiconductors. Let's move on to the most tracked index of them all, the S&P 500. This is the ending diagonal. We like it, and it is gaining traction day by day. I think we formulated it on Wednesday already, maybe even Tuesday, I think Wednesday. So we've raised the warning levels for the bulls, which is bullish. As long as you raise those levels, it means the trend has moved higher. So the first level is, of course, 5,600. The second level is about 5,530. The fourth level or the third level is right here at about 5440, and then the last level is right here at the low, right? The last Friday's low at about 5400. If we start breaking below each of those, then we know we are going to switch lower for this C wave here. Okay, but for now I prefer this one. Okay, the rally this week is very strong, especially this very bullish reversal candle. And it doesn't surprise me that we've seen two follow-through days. Also here, you can see the upper Bollinger Band has started to expand. Strength, we're above all the moving averages, which are soon bullishly stacked, meaning the 10-day is still below the 20, but once it gets above the 10, it gets above the 20, we have a bull trend, as we've seen earlier this year as well. We're holding the Ichimoku cloud, we're holding the 200-day, we're holding the 50-day moving average since Wednesday. So this looks great. Really, it looks great. And we have now a new buy signal on the MACD, strength in the RSI 5, and we can get way more overbought. This is not a warning level. Markets never crash from overbought. They crash from oversold. Okay. They top in overbought, but they don't crash yet. That's something else. The tops are often smaller tops. We need to see really oversold levels like you saw here in April. And you can see when we start moving higher. It's just the reverse of overbought. Then this is the alternative that we have a B, and a C wave underway for a very complex wave 4, back down to the low 5,000s once again. I have zero indication this is the case. If anything, this does not look right, but it is a possibility. Again, I have zero indication, so do not really, if I may say any trade advice, and I shouldn't, do not short this market. That's really, I think, the dumbest thing to do right now. Why? Because there's zero indication that there's a top in place, because we've not broken below any critical warning levels for the bulls. All right, I'd rather short if we drop below 5,400 than short here at about 5,650. The chances that this 5,650 is going to fail as a short are much higher, in my opinion, than if we drop below 5,500. I'd rather have less gains but more certainty than more gains and less certainty. All right, it's all about risk management. That's what we're doing. And here the risk is very high because the charts look very bullish. And that brings me then to the IWM. The IWM wave count can still target 230 to 246, potentially as high as 273. But as you can see, we have the green sea, the red sea, and the black sea. Not that geological body of water, but the black sea of blue wave B. Here, all confluencing at around 246, 241. Wouldn't surprise me if this is going to happen. The warning levels for the bears have been broken 3 times now, orange, gray, and blue. So that means the warning levels for the bulls are, of course, now pretty much today's low, and then, of course, yesterday's low, and then, of course, Wednesday's low, and then finally the August low. Okay, those are the warning levels for the bulls. I'll switch them around here. I have it bears and bears for both, but I'll switch them around on the chart. Let me do that right now so you can see it better. Also for those that will tune in later on YouTube days after the fact. But, you know, that's what you get when you don't pay for it. So here we go. This is our first warning level. Then the last warning level is, of course, right there. The second warning level is right there. And then the third warning level is right there. There's other warning levels for the bulls. All right. Very simple. Let's keep it right there. And then, of course, for the bears, we can have a 1-2-1-2 setup. Okay. It does count reasonably okay as 5 waves lower. 1, 2, 3, 4, 5. Okay. 1, 2, 3, 4, 5. So then we have to hold, of course, below this August bounce high. If we don't, very simple, then of course we're going to break to this 240 level. And if we hold below it, and then we break below the September low here, this week's low, then this green wave 3 is confirmed for 5, 4, 5. That was then the pattern I will look for. I have some reservation about this ending diagonal. This is not, in my humble opinion, a true ED based on Elliott wave rules unless I move this gray wave forward, just 1 day forward for something really ugly and weird. So this is an unorthodox top. I don't believe it till I see it. And I'll see it if we don't go above the August high and if we drop below the September low. That's it. Then I'll see it, okay? That's really the crux of the matter here. So those are all the major indexes that we've been tracking. Let's move on to market breadth. Again, market breadth is almost above 70, which is 2/3 of the internals of the market. So 2/3 of all stocks are on buy signals. That's a very good chart. This is not bearish in my humble opinion. This is the AD line, made a new all-time high. That's not bearish. End of story. This is the new lows for the NYSE and for the NASDAQ. Benign at 10 and at 60. This is benign. This is not bearish. End of story. Let's look at the McClellan oscillator for the S&P 500. Today it ran to 25. It means more stocks are advancing than declining. That's bullish. End of story. Summation index did not give a sell signal yet. It just kind of got rid of its overbought conditions in the recent decline, and it's starting to turn back up because, of course, the McClellan oscillator is back to positive. This is not bearish. End of story. The PMO buy all indicator gave a buy signal today from an ideal bottoming zone. Look at this nice green candle. Now the KST of the PMO, which is just smoothing it out, hasn't given a buy signal just yet, which will take a couple of days, but this is not bearish, not bearish. End of story. Everything I showed so far is not bearish. Now the market might really throw us a curveball here. I don't know, but interpretation of the data tells us not bearish. Let's look then at sentiment. What is sentiment doing? Active money managers, so the professionals, are only 72% exposed to the market currently. That's almost underexposed because it's right at the long-term average. So that's kind of bullish. How we're doing on the individual investors? Well, their bullishness has dropped over the last 3 weeks down to 30%, or sorry, 40%. Bearishness has increased. So we're kind of at, average levels here. That's not bullish. Of a bearish, sorry, that is not bearish at all. This is normal, okay? So this is really mixed, normal. If anything, there's plenty of room for rally. How about the CNN Fear and Greed Index? It's neutral, plenty of room to run. Last week we were in fear, a month ago extreme fear, and now we're neutral. Okay, that's neutral, right? What can we say more about this? This is not bearish. End of story. And then we're going to look at seasonality. Okay, some things just don't work. Doesn't mean it is not useful. Seasonality is very useful. A lot of people use it. Currently, it's not working. We were supposed to top here a week ago and then decline all the way into October. See this? And so far, it's not happening. Yeah, but how about election years? All right, we'll just filter out all the election years. Okay, same here. We're supposed to stop in the first week of September. Remember, I said that that looks pretty good if the market so desires to top, and then we're going to decline all the way into October. Just election years. We're currently keep on rallying, so the seasonality is out the window. Doesn't mean seasonality is useless. It just means we're not following it. Okay, not the average path. So we're not going to use it for now. Just wanted to make sure that sometimes things just don't work. So overall, I think we should start to focus on the ending diagonal until proven otherwise, which are breaks below the warning levels for the S&P 500. I think the semiconductors are either doing a larger bounce or a very protracted B/2. I still think they have topped. They have so much more work to do compared, for example, to the S&P 500, which is just, that is just inches away from an all-time high, and the semiconductors are still miles away from the all-time high. So I think the semiconductors still can have upside play left, but overall bigger picture not looking as good. Dow Jones, I still think we can go in deeper into the 40,000s, that we can easily add another 1,000, 1,500 points to the current rally for this expanding ending diagonal that we've been tracking, and that is now our preferred wave count, contingent on holding above these warning levels. And the NASDAQ 100 can either do a more protracted B wave, contingent on holding, of course, also below the warning, above the warning levels, or a expanding ending diagonal. It all depends on, did we count the October-December price action correctly as a 1-2, or did we count it incorrectly? And that was still part of the bear market that's ended in late December for the NASDAQ 100. And then we've topped for a 3, bottomed for a 4, similar to the S&P 500, and I would say the Dow Jones, though the Dow Jones is slightly different, but the end result is the same. Also, the Dow Jones will go to new all-time highs. So that's a little bit where we're at. And even a protracted rally to 20,200 can even be exceeded to about 20,600, 700 for a more complex flat type B wave. All depends, once again, did we get the October-December 2022 price action interpreted correctly? And did we interpret the July into August decline correctly? Was it an ABC or was it 1, 2, 3, 4, 5? I know you want to hear the definitive story. I can't at the moment. I don't really know. I do know both look for now higher, contingent on holding above the warning levels set on the charts. And that should be enough for most folks. For now, from that sense, from a bigger picture, it's still a little bit more muddled, but I think we can safely say we should look for higher prices, because all these market breadth indicators are also still looking long and strong. We just got renewed buy signals from an ideal bottoming zone, and that must really be taken to heart, while sentiment is neutral to negative, and neutral at best. So there is plenty of room upside before we get very greedy. I hope you really appreciate this update. Take care, trade safe, and I'll catch you all next week.